हाँ जी, welcome to first episode of Vishal Wealth View. So, uh, I think I have starting my investment journey and I wanted to create this channel ताकि मैं अपने सारे investment decisions का log कर सकूँ. And in today's episode, I'm just going to talk about like the journey so far and like how my assets are distributed and what are we going to do next, like what's our goal. Apart from that, मैं इस channel का use करके like I'll also do some amount of research and I'll also try to log it off in these episodes and also share research that I'm doing with all of you. uh, Apart from that, in today's episode, I'll also talk about the philosophy that I have developed over the years, in last 4 or 5 years regarding investment, and we can discuss a few points about that philosophy. So, yeah, let's jump into today's episode. So, initially, I think I'm at a stage in my career where my assets have grown up to 1.4 CR. It's mostly across Indian equities and debt. Almost 84% is in stocks, which is distributed like across mutual fund and Indian stocks. So mutual fund portfolio, the story behind this portfolio is like as soon as I got into workforce, I started working. मैंने initial equity investment mutual fund में किए just to make sure कि मेरा capital protected रहे and I'm not incurring huge losses. So I stayed away from crypto, Bitcoin, and anything that I cannot understand and it's not like regulated. So उसके अलावा almost 46% is in stocks. I think recently I'm building positions in these ETFs because I find them like a better control of money than mutual funds. And it's like strategy based, so I don't have to worry about stock selection. उसके अलावा मैं खुद अपनी रिसर्च से like I've been investing in these companies. I think there is a case where money can be made in these investments. So I'll probably discuss about each and every one of these in like further episodes. Apart from that, we have some money in large cap companies. This is relatively stable. Then some amount of money in mid cap. This is Nika. If you guys don't know. So yeah, that's how like the portfolio is structured right now. Uh, if we see the like the stock portfolio जिसके ऊपर अपन like mostly काम करेंगे and we are going to mostly make decision around this portfolio. So like just an overview, this we only have 12 holdings and majority of the money is distributed across ETFs. I think more than 50% of the capital is in ETFs, and उसके अलावा we have some individual stocks. So some might criticize this like a really concentrated portfolio, but I guess that's the key to get rich. Like understand your investment, minimize your bets, and make sure you're diversified enough in a way that you don't get yourself wiped out. So I think we are going to follow the same philosophy. So we'll try to understand each and every company that we are investing in depth, and we are going to stick to our investment for a long period of time. So I have added ETFs over here because I think they serve as a good like instrument for capital protection, because there's a good amount of downside protection that I can expect when I'm investing in an ETF. I know for sure like my money is not going to go away 40% or 50% in a month or so. Like it can once every 50 years, but yeah, mostly I don't have to worry about that when I'm investing in ETF. So talking about the investment philosophy uh, that like I developed over past few years. So I think there are 5 buckets that I try to put every company into, or try to analyze every company that I try to invest in. So what is the quantitative nature of the company? Like what's the current standing of the company, what's the market cap, who are the competitors, how is it faring against the competition. Then what's the stake of promoter? Usually I want a company in which it's a win-win scenario for like the public shareholders and the promoters, because they are the one who is taking all the calls, running the business. I do like to see my company growing at or like the place where I'm investing growing at a rate higher than 20% with a good uh, uh, like good ROC, which is the ability to like generate returns out of any capital that a company is putting into the business. We do want to watch out for leverage. I think this is one key factor in the companies we are investing in. We don't want to uh, like invest our money where we have a chance of losing everything, and if a company is bankrupt because of its leverage, you're losing all of your money. So we don't want to go there, and we want to specifically observe this signal whenever we are like investing a company or tracking our companies. Then there is qualitative nature of company that we try to analyze before investing. We like a business that has a consistent and predictable cash flow. Usually, these are consumer durables. Uh, like consumer durables come into this category really often. Uh, then we want a business that can generate higher return on capital, like over a consistent period of time. Like you should not be running into a situation when you have to go to the bank after 3 or 5 years of awesome returns to expand your business, or the amount of money that you're putting in should be able to generate exponentially higher returns than the amount invested. Then the business that we're investing in has to be a monopoly, or there has to be a moat that is protecting this business against all other companies in the same competition or like in the same industry. Should be listed for more than 3 years. I want to see how is the management like performing in terms of what they're saying in the quarterly earnings and transcripts, and is it matching the reality. So this is something that is also non-negotiable for us. उसके अलावा we want to invest in business model जो कि predictable है, they are not changing for next 3 to 10 years. We want to avoid places where innovation can happen so that our money can compound for next 3 to 10 years. Should be simple to understand, should not be a complicated company, not needing huge leverage, and if it is having high margins, it's like cherry on top. Usually it's hard to find all these qualitative nature at the right price. So what's the temperament that we need to follow? So the temperament that we need to follow is we need extreme patience. We are not going to take any hasty decision. We are going to think about logically regarding every investment decisions that we are making, any choices that we are making. We have to be completely unemotional and rational while making those decisions. Although ये सारी कहने की बातें हैं, आसान है कहने के लिए, but when market is down 20%, 30%, it's really hard to be rational and unemotional. उसके अलावा whenever we are trying to invest in single equity, we have to do intrinsic value calculation, and we have to understand how is the intrinsic value affected by the qualitative factor of a business, which is usually not included in the plain old intrinsic value formula. Then how are we going to build position? Like these are certain rules, which is we are not going to invest more than 10% of our capital in a single equity, and we are going to invest it over a period of 3 to 6 months. And if any single equity go beyond like 50% of our total net worth, we'll start cutting those position, and we are going to use ETF for our capital protection. Apart from that, since majority of the capital जो हम यहाँ invest कर रहे हैं is allocated to Indian equities, I think we should all be aware about like what are the risks Indian equities face in the past, in the future, what has been the history of Indian equities. So Indian equity market has been like primarily affected by inflation. So we need to keep an eye out on any inflationary activity that government is doing. And I think current account deficit and fiscal deficit are a good signal uh, to see if inflation can go up or can go down, because whenever we have these deficit, government has to either borrow money or print money, and both of them are inflationary activities. We also want to like keep a health check on how corporate India is performing in terms of what's the NP of big banks like HDFC, ICICI, SBI, and also the smaller banks or small finance banks. Apart from that, we also want to see like just a signal how's the debt to GDP ratio, and what's the valuation of the market look like. So we want to be green on majority of these possible risks to Indian equities, while our money is heavily invested in the market. And when most of these signals turn into red, we want to rethink about decreasing the allocations, moving more to debt, and things like that. So this is the structure that I have came up with. So yeah, that's it for today's episode. Let's see you guys next week.